Penguin Random House Audio presents The Fed Unbound, Central Banking in a Time of Crisis by Lev Menand. Read for you by Mark Deakins. For Emily, with unbounded love and affection. Preface. During the summer of 2007, the U.S. financial system began to break down. At first, the parts that gave out were minor and unimportant. In July, two obscure hedge funds run by the Wall Street broker-dealer Bear Stearns collapsed. They lost nearly all of their investors' money. In August, the French financial conglomerate BNP Paribas blocked withdrawals from three of its investment vehicles due to the complete evaporation of liquidity in certain segments of the U.S. mortgage market. Policymakers on both sides of the Atlantic were stunned. 6 months later, Bear Stearns itself was on the verge of collapse. Within a year, more and bigger pieces of the financial system had stopped working, a panic had broken out, and dozens of large companies were hurtling towards the abyss. A climax arrived on September 15, 2008. Lehman Brothers, one of the most profitable firms on Wall Street, filed for bankruptcy. In its court filing, Lehman cited $613 billion of liabilities, by far the most of any bankrupt company in history. Given the role that Lehman played in the U.S. economy, circulating money between households and businesses like a heart pumps blood around a body, a wave of similar failures would almost certainly have meant widespread business closures, job losses, and another Great Depression or worse. That we did not experience such a collapse is due in large part to the efforts of a single institution, the Federal Reserve. The Fed, as it is usually known, scrambled frantically in 2008 to keep the gears turning and the blood flowing. It did its traditional work of lowering overnight interest rates, bringing them down to near zero. It also took a series of extraordinary actions, crossing red lines, stretching its legal authorities, and using its balance sheet to lend to financial enterprises of all sorts. Ultimately, with support from Congress and the Treasury Department, it staved off disaster. And yet, today, the Fed remains stuck in emergency mode. In March 2020, a second panic broke out, triggering an even larger Fed response. Meanwhile, the malfunctioning that began in 2007 spawned a series of further crises, economic and political, that are reducing economic security, widening wealth inequality, and damaging American democracy. As these crises worsen, the Fed continues to take on more responsibilities and further expand its purview. Few saw this coming. Indeed, a decade ago, following Lehman's bankruptcy, many suspected that we had reached the end of a second Gilded Age, a multi-decade period characterized by a large and expanding financial sector and rising inequality. They predicted that the financial sector would contract and inequality would subside. The Fed, too, they assumed, would go back to normal. Now, however, it seems clear that the acute panic in 2008 was just the beginning of a new phase, one in which the government's part in facilitating sprawling financial markets became explicit, and the Fed, an organization built for limited regulatory purposes, emerged as a site of enormous economic and political power. Importantly, this shift is not unique to the United States. Japan experienced its own 2008-style breakdown in the 1990s, which was followed by an extended period of economic stagnation. In response, the Bank of Japan pioneered many of the unorthodox methods that the Fed has since tried here, including massive balance sheet expansion. Today, the Bank of Japan holds assets worth over 700 trillion yen, approximately $6.5 trillion, more than 10 times the amount it held before the 1990s measured as a percentage of Japan's annual economic output. In Europe, the transformation has been even starker. The 2010s were a decade of extreme monetary dysfunction and rolling depressions in multiple countries. The European Central Bank, known as the ECB, spearheaded a host of unprecedented measures to prevent the Eurozone, the collection of European states that use the euro as their currency, from disintegrating. Many of the ECB's efforts continue still, including its monthly purchases of tens of billions of euros worth of public and private sector securities. But if this is a revolution, it's of a very odd sort. As we will hear, the rise of Atlas-like central banks engaged in perpetual crisis management is the product of a conservative impulse. Today's Fed officials are not aiming for radical change. They are trying to return things as much as possible to the status quo ante, to the way things were before the summer of 2007. They are trying to preserve a system of globalized finance that their predecessors played a leading role in constructing and that imploded spectacularly 14 years ago. Unfortunately, despite their Herculean efforts, this system remains economically and politically unstable. It undermines the legal framework governing money and finance and threatens our democracy. Among its shortcomings, it depends on central bank actions that, though designed to avoid worse outcomes, transfer wealth to the financial sector and increase inequality. This book makes a case for fundamental reform. It offers a comprehensive look at the Fed and its growing role in our society and argues that legislative gridlock and the erosion of our banking laws has led the Fed to take on responsibilities for which it was not designed. It then explores some of the consequences of this dynamic and suggests better approaches to managing the economy. Rather than continue on our current trajectory, treating the symptoms of an inadequate macroeconomic and financial architecture with a continuous dose of central bank medicine, I argue that it is time to cure the disease by rebuilding our fiscal and monetary infrastructure and placing our economy on more solid ground. Introduction. It is a basic principle of American law that Congress has the power of the purse. No money shall be drawn from the United States Treasury, the Constitution tells us, but in consequence of appropriations made by law. This restriction is the reason why federal agencies shut down when legislators are unable to pass annual appropriation bills. It is also why people sometimes worry that the U.S. will default on its debts. The Treasury Department can only pay the country's creditors when Congress authorizes it to do so. But Congress is not the only part of the federal government that can put money to work. There is another government organization that also has the ability to disperse funds, the Federal Reserve. The Fed is run by a 7-member board of governors headquartered in Washington, D.C., with 12 federally chartered banks, known as Federal Reserve Banks, located around the country. Established by Congress in 1913, the Fed possesses what we might call the power of the printing press. It can create money out of thin air. And the Fed operates independently from the rest of the government, meaning that it can create as much money as it sees fit and use this money without prior approval from Congress or the President. Most people do not think about the Fed or its power to create money. One reason for this is that when Congress created the Fed, it wrote laws carefully restricting how the Fed uses its printing press. The Fed is not permitted to raise an army or fund a space program. Its job is to regulate the money supply, to make sure there is enough money in the economy for everyone else to use, not to use money itself. The Fed is authorized to put new money into circulation in only 2 ways: by buying financial assets and by lending. And Congress limited the sorts of financial assets the Fed can buy and the kinds of entities the Fed can lend to. As a result, Congress has long directed government resources with the Fed's balance sheet in the background. This all started to change about 14 years ago. Facing a severe financial crisis, the Fed used its power to create money to avert an economic meltdown. In March of 2008, it lent $29 billion to prevent the bankruptcy of Bear Stearns, the troubled Wall Street securities dealer. Neither Congress nor the White House was involved in making the loan. One prominent legislator later admitted that he had no idea the Fed even had the authority. Neither, he said, did most of his colleagues. The Fed had not invoked the relevant provision in over 70 years. 6 months later, in September of 2008, a group of Fed officials went to Capitol Hill to brief legislators on a plan to lend $80 billion to rescue a failing insurance conglomerate, AIG. They got a frosty reception.
Sample complete. Ready to continue?